Hi there, welcome once again to another live webinar with us from Phillip Nova. And this is Sri, your facilitator of the day. And what are we going to be covering in today's session? We will be discussing, does the dividend story of S-Reits still make sense in 2020? All right, let me give you a little bit of a context. The interest rate hike seems to have come to a slowdown at the start of 2023. However, the US Fed highlighted that there's still a way to go to bring inflation back down to 2%. With the uncertainties as to where the interest rates will be headed to, does dividend yielding asset classes make sense in 2023? Join us as we uncover how ETFs and CSOP S-Reits can help investors better position themselves for the market ahead. And as you can see from the webcam, it's a dashing young man. We have Raphael Go. He's doing intermediary sales with CSOP Asset Management at the CSOP Asset Management. Raphael oversees the ETF investment solutions for brokers in Singapore. Raphael is also part of the team responsible for developing sales strategy and strategic partnerships with intermediaries in Singapore. So you are in very good hands. And prior to joining CSOP, he was with financial institutions like Tiger Brokers and also was a client advisor at UOB. So you're in very, very good hands today. And before I start the session, can I just do a very short poll just to assess if you can hear me loud and clear? All right, we have 75% with a yes and 25% with a no. Raphael, can you hear me loud and clear?
Yes, I can, Sri. Thanks for your kind
All right.
introduction.
All right, great. Raphael, before I hand the reins over to you, members of the audience, if you have trouble hearing, I highly recommend you replug your headset and see if that solves the issue. Okay, this session is also recorded, so rest assured if you have technical issues, don't worry, you can still watch the video recording and revise on the insights shared today. Raphael, if you're all set to go, let me hand the reins over to you now. Raphael, please.
All right, thanks, Sri. All right, a very good evening to all of you. Thank you for joining us today in this webinar. So basically, I understand that Phillip Nova has recently ventured into the security space, and it is a pleasure of CSOP to be able to join this, push off this forefront with Phillip Nova. And today's topic will be sharing on whether the dividend story of S-Reits makes sense in 2023. So S-Reits itself, it's a beautiful share class, or rather asset class in this current market. So basically, it has also been favored by most investors as one of the asset class that provides a regular stream of income. So when we talk about getting streams of income, building your investment portfolio, definitely when it talks about income generating or dividend payment, S-REITs is definitely one of these asset classes that investors do keep a lookout on when investing. All right, so for today's topic, I'll just be sharing a few key updates with regards to S-REITs overview. And in fact, earlier on this evening, SGX has just published a report on S-REITs itself. So in January 2023, S-REITs itself has actually showed a growth of 7%. So I think with this in mind, I think there's a lot of things that we can talk about in today's session. All right, so S-REIT itself, sunshine emerging after the rain. So we know that in a post-pandemic world, within the S-REITs industrial sector, we saw a rate compression of the cap rate compression of 100 to 200 BPS, rather basis points. And this actually shows that a recentered yield band at a lower range, particularly with a strong and medium growth term growth outlook. So the thing about cap rate itself is that cap rate itself represented by the net income divided by the current asset price, the current price of the underlying asset. So usually this such a compression actually means that represents market recovery. So in terms of this China's reopening that we heard since the start of the year, it has actually allowed retail rents to be favored, and that travel to benefit Asia to benefit from this new, or rather these relaxed uh, policies from this China side of things, and they will uh, allow uh, the, 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 the Chinese citizen to now be able to travel. So for instance, we see that now, even with lower asset values, higher gearing levels, adjusted interest coverage ratios for most REITs should remain 2.5 times across 2023 and 2024. UBS also recently have re-estimated or revised their outlook on S-Reits itself. Dividend per unit estimates have also been revised from a minus 24% to plus 9%. So this also resulted in a change of minus 31% to a plus 10% change in price targets. So for today, we'll be looking at some of the valuation, like as I mentioned earlier on, within the industrial REIT sector. You see a cap rates compression, and office capital values seems to increase because of this relaxation of this COVID policy. And now that everyone is back to work, office spaces are also high in demand. So we can see that actually the per square feet basis, the capital value of office spaces have been steadily on a rise. So, unlike the rest of the world has seen a decline in the property market because of the rising interest rate environment. However, on the contrary side of things, Singapore actually see a contract. Unlike the contraction trend, Singapore actually see a growth in terms of the demand for office spaces as well. So this was particularly driven by most of the financial sectors as well as the tech sector. So we expect when these upcoming reports are on the end of financial year end 2022, we expect to see that Singapore office rents to grow 9% for the financial year end of 2022, and this would actually mean that a new high of even higher than the pre-pandemic levels, to a new 14-year high. For the industrial side of things, although global supply chains seem to be disrupted, but however, on the Singapore spectrum, we have seen that demand continues to be driven by the life sciences and biomedical companies, as well as more of these tech companies, as well as semiconductor companies coming and reinforcing their presence in Asia and Singapore. However, due in the midst of a global slowdown, this may also mean the weaker demand. But nonetheless, I think the industrial sector is still preferred because of its defensiveness and its long or rather the weighted average lease to expiry. So this will also allow investors to be able to tide through during economic slowdown, times of economic slowdown. Well, retail space is definitely most favored during this period, where we see the relaxation of all from all nations pertaining to the COVID crisis that we've seen previously. So tenant sales also paints a similar recovery picture as we can see. And the thing is that the decline in rent during the period of COVID-19 period, it provides a lot of headroom for growth going forward. And the expectation for a mild positive rent reversion in retail rents going forward, as there is still a limited supply of retail space in Singapore, should aid overall recovery. So we also prefer that the city fringe retail over the suburban retails, at it has more headroom for growth due to relaxation of borders and inbound tourist travelers. Well, we see that there's a growth in terms of the retail space. Hotel space is also one of the few sectors keeping an eye out on, and that this is definitely one of the space to keep a lookout on, as we know that China has relaxed its COVID restrictions and all, and with the removal of such travel restrictions, it will allow strong consumer demand in terms for traveling. Whereas we can see that the Asia Pacific lagged 30%, at 30% due to the lingering travel restriction previously, while Europe and America saw 85 and to 75% of their pre-pandemic levels respectively. In fact, recently we saw that the revenue per available rooms have bounced back with a vengeance, with average room rates in Singapore is standing at $277 a night, and this is around $43 higher than pre-pandemic levels. Well, in the inflationary environment, you may think that how has this got to do? Hotels are more well positioned in a way whereby they can always reprice the price of these stays for travelers or for its customers to pass on this cost to its consumers. On the China reopening front, definitely they will definitely paint a positive picture for S-Reits, as recently there's a poll has shown where are the cities that these Chinese travelers will actually go to once the border is relaxed, and Singapore is definitely one of its top places that the Chinese tourists will want to travel to, and this will allow these both retail as well as the hotel sectors in Singapore to be able to benefit from the relaxation of these COVID policies. So next up would be, you might be thinking with the relaxation of all these sectors, and while the rest of the world is seeing crushing fate towards its property sector, but Singapore itself has been resilient, and in fact we've grown 7% since the start of this year for our S-REITs. So in terms of asset class, S-REIT itself, it's definitely one of the asset classes where investors think about dividend payments. They will definitely look for S-REITs as one of the asset class, as it pays off for REITs itself to be categorized as REITs. The business has to pay off 90% of its income. So more on to today's topic on S-REITs and why ETFs make sense for investors. All right, ETF basically stands for exchange traded funds. Basically, it allows diversification. It holds a basket of securities as underlying itself. It is also easy access instrument for investors out there in the market. And generally, ETFs have lower management fees compared to these actively managed mutual funds out there in the market. However, the downside is that definitely there is a shortfall that ETFs compared to mutual funds. Some of the mutual funds, they are actively managed, whereas ETFs themselves, they are passively managed, and more often than not, they are tracked based on a certain index, which is why I'm going to share with you further in depth on the index that we'll be talking today on S-REITs. So today I'll be sharing on about our CSOP S-Reits Leaders Index ETF. So our SRT, or rather our CSOP S-Reits Leaders Index ETF, is currently one of the best performing S-Reits ETF out there in the market today. Comparing to our local peers that are in the market, actually we fared well, or rather we are still at the top spot since our launch in November 2021. So our IH S-Reits Leaders Index ETF has also opened the year strong. We came in 7.6%, strong return of 7.6% in the month of January itself, and the underlying itself have fundamentally fundamentally strong, and we usually give only the large and mid cap segments of the S-Reits will be factoring into the IH S-Reits Leaders Index. So in terms of pricing wise, you might be thinking, is S-Reits a bit pricey at this current juncture? And we are talking about inflationary environment where interest rates are still climbing amid a bit that is slowing down, but it's still climbing. Yes, there's opportunity. So it eventually boils down to what are your investment objectives. So for S-Reits itself, usually investors, when they invest, they tend to look at a longer time horizon period. And because of its regular stream of dividends that it's being able to pay it out at times, it's always preferred that investors hold S-Reits as part of their core portfolio. So for our IH S-Reits Leaders Index itself, the underlying itself, the estimated yield that we're looking at is around 5.6%. The of the index itself we are looking at is around 18.9, and the price to book is slightly on the par value of 1. So why the IHS Leaders Index ETF compared to the rest of its peers in the market? Conversely to the rest of the peers in the market that trades or rather tracks or assign weightage usually based on market caps, the IHS Leaders Index only focus on the large and mid cap S-Reits firstly. Secondly, it is also rebalanced based on the average daily traded velocity calculated over the last 6 months. So the higher liquid REITs will be assigned with higher weightage, while the lower liquidity REITs will be assigned with a lower weighting factor. So with this in mind, it actually means that while we understand that retail investors like you and I are not able to move the market, but we can actually keep track of what the institutional space, or rather the institution space, they are doing in the market. And this will also allow investors to gain exposures to the relevant sectors that better represents the current market conditions. So for our IHS Leaders Index itself, we are looking at is currently there's 26 underlying itself. So mainly currently the portfolio focuses a lot on the industrial REITs. Currently stands at 36.1%. Previously it was at 40%, but because of the market movements, it has since during rebalancing, it will be positioned according to the current market trend. So we also see that the increase in retail rent during the previous rebalancing phase, as well as the increase in office space in anticipation that the return to office to work is a norm, and that this index itself will position itself to the representation of the current market situation. So the geographic allocation itself, like the name stands, S-Reits 61% represents the REITs managed in Singapore, while we have 13% in Australia, US a mere 6%, and other broader markets like China 5%, Japan 2%, and other India and which other space on earth just a mere 13%. So for this ETF itself, it's rebalanced semi-annually, so it will be rebalanced twice a year, both in March, once in March and once in September. So there's two share class for this ETF. Basically, the SRT representing the Singapore dollar share class, and the SRU representing the US dollar denominated share class. So you guys might be wondering, when I talked about earlier on the large and mid cap S-Reits, what does this actually represent? So to be able to be qualified as a large and mid cap segment of the REITs itself, first off, the market cap has to be at least 500 million Sing dollars or equivalent before it is able to be considered as a large or mid cap, and to be able to be authorized to be placed on this index itself. So there is also index cap. So we cap around 10% for each security, so that you will not be overexposed to a single underlying security. All right, so you guys also might be wondering, what's the management fee like? So the management fees currently stands at 0.5% per annum. So it's really a small sum of fees out there to manage this portfolio of REITs, and it's capped at 0.6%. So not to worry, these are not fees that are being passed on to you on the front end. It will be charged on the NAV side of things. So for investors, definitely you will not feel probably won't feel any differences on this front. All right, so you have heard the story of the S-REITs and the growth. Why do we actually prefer the large and mid-cap S-REITs? Because large S-REITs usually they are government-linked REITs, and such companies usually they are able to negotiate for better deals out there in the market. Whereas the mid caps REIT will allow a higher yield as well as stable cash flow and sector diversity incorporated within the index to provide a yield enhancement for the ETF holders. So as a proposition, definitely unlike the traditional uh, indexes out there which assigns higher market cap equals to higher weightage, this index itself, we focus a lot on the daily traded velocity, and is being tracked every 6 months before prior to its rebalancing phase. So this will also in turn represent give a better representation of the current market conditions, and investors themselves don't have to necessarily to have to do their own to redo a rebalance, portfolio rebalancing and all. So it's a pretty much a robust index that keeps on changing pertaining to the ongoing market changes. Right, so with that, I come to the end of my short presentation. If you have any questions, just feel free to type in the chat box or whichever. Sri, are you there?
Hey, Rafa. Yes, I'm still here. Rafa,
Yes.
sorry. I think your video had frozen halfway through the session. I'm not sure
Oh,
if it's the connection. Feel free to turn it off. It allows you to explain during the Q&A much better.
okay, cool,
Um,
cool.
okay. I just wanted to ask very quickly, before I ask the first question, members of the audience, if you have questions for Rafa and would like to learn more about the IHS Leaders Index and how is it different from the other indices that you've come across, please type your questions into the question box. You can find it located somewhere at the bottom of your control panel. Just click on it and type your questions in there, and we'll send them to Rafa. All right, we have the first question here. Win is asking, with Fed rates still set to rise, how would REITs be affected? Should we be worried about, I'm not sure what this is, WALE?
Yeah.
Should we be worried about
So
WALE?
yeah,
Yeah.
WALE stand for the weighted average lease to expiry. So the average weighted lease to expiry actually means that the current ongoing rents, how are they positioned, and it is very important for REITs company to have a long WALE. It also means that if you have a longer WALE, it actually means that your income is pretty much locked in. So with that in mind, definitely a rising interest rate environment may be bad for REIT, particularly because of the higher cost of capital required, or rather the financing costs to be required for new acquisitions as well as for business expansion purposes. So it also means that layman's term, if you want to take up a new loan for your business expansion, interest rates will be a key concern. But I think to address this question is that first off, what is your investment horizon? Because first, the asset class of S-REITs itself presents opportunity for investors mainly because of its regular stream of dividend payments as well as income. So for high interest rate environment, if you were to refer to the past events, usually markets are not able to withstand high levels of interest rate environment for a longer period of more than 2.5 years. That's the based on past references. And with that in mind, if your investment horizon is longer than the 2.5 years or whichever, it actually makes sense because at any point of time, should you feel that it is a reasonable amount of rather the pricing of the current REITs is reasonable enough. um, I think it is always good to build in true dollar cost average strategies, as this is still eventually a asset class that earns you yield rather than I mean at the end of the day itself, there's still chance for capital appreciation, but unlike traditional businesses may forego some of these dividend payment to reinvest in their R&D structures to improve on business processes. So with that in mind, um, if you're going for capital gains, definitely this is not I won't say that this is not the asset class, but rather the capital gains will be pretty much limited, because REITs itself pays off 90% of its income to its investors or its shareholders. So while you may be wondering, will it be a concern? I think at this current juncture, where we look at the adjusted interest rate cover ratios for most REIT, we are looking at more than 2.5 times across 2023 to 2024, and these are rather seemingly healthy levels. So if you would ask me, definitely in terms of growth space, certainly some REITs may hold back some of their purchase or acquisition, unless there is a particularly seemingly nice or rather favorable deal to these companies. Then they will go ahead with the purchase, because as we know, the financing charges at these current levels is relatively I won't say it's cheap to finance new purchases looking at this current interest rate environment. Yep.
Hey Rafa, okay. Next question is from Y. He's asking,
Mm.
are the expenses amortized over say 12 months to be fair to all ETF holders?
On our end, we will amortize it accordingly. So the expenses, they are pretty much charged. If I'm not mistaken, they are amortized on a daily basis. It's not a one year one time charge itself. So it will be spread across the time horizon to ensure that every unit holder is a fair uh, is fair towards all unit holders.
In
Yep,
terms
that's the
of
answer.
in terms of what you have shared today, what do you think are the three key takeaways for the members of the audience?
If you would ask me three key takeaways, I would say that traditional index itself, usually we look at the broader market indexes. They tend to assign higher weightage to higher market cap companies. But in fact, this may also not be accurate in certain manner, in a sense whereby we understand that how certain market feels within certain segment. Um, Perhaps there may be an opportunity towards some sectors, and which is why the liquidity free adjustment makes a lot of sense for particularly the REITs sector. Mainly because we know that there will be sector rotations, ongoing rotations, fund flow from industrial REITs probably to favoring this hotel and retail space in this current environment, especially some of these office spaces that we're looking at in this current environment. Um, this will allow better representation of how institutions position themselves going forward. And that with a traditional, if we were to go to the traditional route of indexing and assign higher market cap, higher weightage, this may actually skew towards the particular sector that the large market cap company is tending towards to, and that in a way whereby when it's being adjusted based on average traded velocity, uh, in fact you actually I would say uh, you'll be better represented in a sense whereby once it's rebalanced, you know that, hey, actually I am at the correct space uh, after all this while.
In terms of people who are new to S-REITs,
Mm.
what do you think for this? What are some of the key things you would have to take note of before maybe you consider investing in a REIT?
Yeah, very good question. Well, I understand that most clients here do trade futures and all. Certainly, definitely we are not looking at capital gains per se when we are focusing on particularly S-REIT share class. But nonetheless, definitely there will still be room for growth for S-REITs. Um, Key thing to take note of is definitely when we talk about REITs, right? First off is that are the REITs able to continue pay off its dividend, because first off, like I mentioned earlier, the weighted average lease to expiry cannot be, first off, it is like baking a cake. You cannot be too long, cannot be too short, because if it's too long, should market changes, you're still stuck with the previous rental income. But when it's too short, then again, you may be impacted because of the current market environment. So it has to be just nice. So based on the uh, past guidelines, or rather a good assumption rate of a nice representation of the weighted lease to expiry, or rather WALE itself, we are looking at is around 3 to 4 years. As long as you see that the average weighted lease to expire for REITs is 3 to 4 years, I think on this spectrum, first off, you are already um, you give yourself a runway whereby you know that going forward you'll still be receiving dividend, but should there be a need to change, you'll still be agile enough to make the relevant changes. So when we talk about our IHS rate leaders index ETF, I think the beauty of it is that we focus only on the large and mid cap S-Reits itself. It don't really look at things below 500 million Sing dollars equivalent market cap. So on that end, you'll be assured that on this segment, your pool of REITs itself are out of quality, and more often than not, such REITs are linked to Temasek and GIC as such. And you know that when you are linked to government linked corporations and all, definitely when it comes down to deals and certain interest rate hedging, you'll be able to get a better rate compared to the rest, which is also the reason why large and mid cap S-REITs tends to outperform the smaller cap ones.
Hey, Rafa, in terms of the sector location that you have here, as well
Mm.
as the index geographical location, would you be able to explain a little bit about the rationale for the particular sectors to be in this index,
Okay.
based on why these sectors are preferred in this order, as well as the respective countries that are in this index?
Okay, so just I apologize that I didn't put in the previous prior to rebalancing, but just I give you an update on this front. On the industrial REIT side of things, before rebalancing, we were looking at around 40 over percent previously. This was before the rebalance in September last year. So when it rebalanced in September last year, in fact, it has seen that the rebalancing side of things, industrials allocation have been adjusted lower. So this was also the market anticipation of a global slowdown in terms of economic activities, as well as factoring into consideration of supply chain disruptions. And whereas while we see that the decline in the allocation towards industrial REITs during the rebalancing phase, we also saw an increase in both retail as well as the office space, as well as some of the hotel REIT space. We saw that there was an increase. So this actually means that the market was already expecting that going forward, um, with the supply chain disruption, industrial REIT may not be that favorable. And going forward, the market probably expects that retail rentals pick up going forward, as well as with the relaxation of the COVID policies by relevant countries have also changed the spectrum towards the hotel REIT space as well as the office REIT space. So we actually saw a rebuffer of increase in allocation in terms of hotels REIT space, the office REIT space, as well as the retail REIT space. So for index geographical location, it actually represents the underlying REITs and their exposure towards pertaining to the various markets. So for Singapore side of things, as this is still as REITs themed uh, uh, ETF, definitely itself underlying, you see the majority chunk being allocated into Singapore REITs itself. However, definitely there will still always still be some of the allocations because of the businesses held by the relevant REITs units. That's why you see that there's still it is still a very diversified geographic allocation. Just that when we look at the majority of it is still pretty much allocated to Singapore REITs, and I think we are blessed in this current juncture, and also because we see while global peers they see vacancies in the relevant spaces, office space, industrial space. But however, because of we know that in Singapore side of things, we have limited resources in that, and this actually boosted us that in fact, while most countries tends to contract, in fact, we have actually seen an expansion or rather a surge in demand in such spaces. Yep. Over to you, Sri.
Members of the audience, if you have any other questions, you can type them right now.
So
Rafa, my
mm,
next question, if you, sorry, you want to go ahead?
yeah, you go ahead. You go ahead first. You go ahead with the question. We answer the question first.
Sure. My next question is so this S3 seems like a yield generation asset. Um, I mean, apart from the fact that it's a yield generation asset, who is it most suitable for? Like, what kind of investors?
Very good question. So actually, I think at the end of the day, it really boils down to your investment objectives. So while some people, or rather maybe future traders, they are more susceptible to accepting risk, then perhaps the returns of this asset class may not be that favorable to the future traders. But nonetheless, when we talk about sustainability, sustainable stream of income, definitely S-REITs, basically you only have a few share classes out there, or rather few asset classes out there in the market that pays off good dividend. First off, I think when it comes down to this, is everyone will be thinking, hey, I buy property, I also can rent out to get that kind of yield. You're not wrong, but the matter of fact is looking at the current property prices these days, and the current interest rate environment that we're looking at, perhaps you may not be getting a deal out of it, but getting a REITs itself is still pretty much a asset class that generates you a pretty decent yield, dividend yielding. Um, and the flexibility of as and when you like, because it's still exchange traded, you can offload it as and when you like through your relevant brokers, like through Phillip Nova. You can acquire it very easily, and I think the beauty of it is still that you can are still able to sell portion by portion, unlike traditional property that is that you cannot say that, hey, I'm going to sell possibly one toilet away to get back some money. You cannot possibly do that. But for the ETF side of things, definitely you are able to do that, because the minimal share class is one, so it's really up to you to how much shares that you want to sell it. And secondarily is that we're looking at is that I think the beauty of this is that you get large and mid cap S-REITs, and these are more often than not government linked corporations, and we're looking at estimated yield of 5.66% is still relatively decent. But I would say that granted that you look at current deposit rates, we're looking at over 4%. You're talking about over 4% of risk-free rates currently. Then yes, that is definitely attractive. But then again, you have to ask yourself, what is your investment time horizon like? Because you definitely, once the time deposit or whichever deposit is up, definitely you will want to park yourself into another share class, or rather another asset class, to earn you that kind of return. But maybe during that time when the interest rate environment isn't that attractive anymore, such prices of the underlying would have already gone up, because likewise market is always forward looking. So at this current juncture, if let's say you feel that it's at a discount, definitely it is something to look out for when accumulating. And when they talk about S-REITs as a asset class, it's about uh, it's about accumulating, and also building up a threshold, or rather a core portfolio that delivers you a stream of income. Does that answer the
Right,
question?
Rafa. Yes, yes, it does. We have the next one from Jonathan. Jonathan is asking,
Mm.
is this index half yearly? Is the half yearly rebalancing based on past 6 months volatility?
It's not based on the volatility, it's based on the average traded velocity. So it will be average traded volume of each individual underlying will be factored in, and it will be recorded over the course of 6 months. And during the rebalancing phase, it will be um, adjusted accordingly based on the traded velocity, or rather the average traded volume of the underlying itself. So it actually represents the higher liquid counters will get the higher weightage. The less liquid counters, meaning to say that probably the market isn't thinking to rebalance, or rather thinking to remove or to acquire at that current time, and then you will be assigned lower weightage in certain sense, whereby um, perhaps there's nothing much to do with it, and that you'll be remained the same. But nonetheless, when there's a higher traded velocity, you can actually see that where the fund flows are moving, whether people are they offloading, or are they acquiring such asset class. So with this in mind, you get a better representation of the current market condition.
Hey Rafa, so that means if is there a possibility that when they do the rebalancing, we
Mhm.
might increase the percentage of the sector that's maybe towards the end of its run, or maybe right at the end of cyclical change.
That is a very good question, but based on what we have seen thus far, we are pretty much in line. Since our launch in 2021 November, this index itself has outperformed all the other REITs ETF out there in the market, and listed in Singapore. So I would say that the index itself is pretty very robust, and it actually gives a very much accurate representation of the market movement. I think that when you're talking about that, possibly um, there may be outperformance by other indexes. If let's say should their mega or their higher cap companies outperform in certain manner, then likelihood then with that different form of assessing in terms of weightage, other index may perform better. But based on the past data that we have seen thus far, we are still the best performing index out there in the market, or rather the best performing REITs ETF out there in the market.
Right, thank
Yeah,
you
back
so
to you,
much,
Sri.
Rafa. Are there any final questions from the members of the audience? We can send them to Rafa to address, especially if you're keen to add REITs to your portfolio. This is a great chance for you to ask questions and learn more about this asset class as well.
Yeah, so I think I just let add a bit on this, and is that basically S-REITs itself is one of the asset class that investors tend to hold if they want to get a stream of income. Um, why S-REITs, you might think so, compared to the time deposit, is that time deposit itself, once the time is up, definitely you have a form of reinvestment risk, meaning to say during that period of time you need to sort out another asset class to park your funds at to achieve you a certain form of return. So when it boils down to that, it really depends on what the individual investment horizon is like. Secondly is to look at the individual's investment goals. So if your goal is to receive a stream of income, getting regular dividend payments, then definitely S-REITs, fixed income, these are the few asset classes that one should be considering. But if let's say you are susceptible to risk, you cannot take any form of risk, then definitely this is not the asset class for you, because ultimately risk itself is still being traded like an equity. There will still be risk involved. Just that unlike conventional businesses, REITs itself, they are obliged to pay 90% of their income as a form of dividend to its shareholders.
Thank you so much, Rafa. Would you be able to address couple more questions?
Yeah, sure. Feel free.
All right, we have one more from Win. Win is asking, generally, what is suggested for REITs as a percentage in a portfolio, 30 to 60%? Yeah, what are your thoughts, Rafa?
For the asset allocation wise, usually I don't advise on this front, but nonetheless, it's really, I would say it really boils down to where in life are you, and what is your uh what is your investment portfolio like, and what is your profile, and what's your stomach, what's the risk that you can take. Definitely, when we look at asset classes, REITs itself is one of the few asset classes that are more resilient during market downturns. In fact, during the COVID period, we saw while global indexes came down 40 over odd percent, the S-Reits, IHS REIT Leaders Index just came down by a mere 18%. So, in fact, if you were to consider that into factor, uh, definitely the drawdowns are slightly lower, but then again, it really boils down to what's your investment portfolio like. Because I don't want to be the one to say that you should go in 60%, but it really depends on what do you want to achieve out of your investment portfolio. um, because out there, in such a high interest rate environment, it also may be a good time to look at certain companies that you have actually want to get into, but did not have the chance to go into previously during the low interest rate times. So such companies would reflect like the tech counters that you see that they get hammered pretty badly this time around, really because of the high interest rate environment. And the reason behind tech companies and high interest rate environment, why is it so negatively correlated, is also because that you have to understand that the matter of tech companies, they are actually pretty much susceptible to interest rate risk, because they need to use a lot of capitals, to inject a lot of capitals to do their research and development for progression of the businesses, such as the name tech itself. So during high interest rate environment, when investors like yourself will probably move to time deposit risk-free asset classes to earn a decent yield, then that is where you see the non-performing, or rather the non-performing tech companies being slashed, and budgets are being tightened. Such companies will have trouble finding liquidity to carry on their research and development going forth. So these are some of the key things that while investing, you should also be aware of. Because for instance, certain companies with strong balance sheet would tend to buy back their shares when in such environment whereby everyone is selling. They see that there's still a proposition of their company, and if a tech company can still buy back their shares in this current environment, it actually shows something that, for instance, a company is pretty much confident in what they have to deliver going forward. So these are some of the key things to look at. But as for the REIT side of things, REITs, you're looking at in an aspect whereby we are trying to build a stream of sustainable stream of income. And REITs itself, like I mentioned earlier several times, 90% of its earnings is being paid off as dividend. You can be sure that definitely there will be some form of dividend payment, high or low, really depends on how the company performs. The weighted average lease to expiry is also one key concern, and whether the businesses going forth, what is their time of acquisition or expansion, is also pretty much will affect the whole businesses overall. So these are the few factors to actually think of before allocating to the relevant sectors, relevant asset class that you have been looking at.
Hey, Rafa, just wondering, you mentioned that the business, based on the business performance, you will determine what kind of dividends you get as well.
Yes.
Like, is there so that means it's not a fixed figure for which you get a dividend for the year. Could you explain a little bit about what is the maybe a projected figure, and what kind of figures can you expect based on how the businesses perform?
Okay. Very good question, Sri. But just have to let you know, basically REITs itself, right? To be categorized as REITs itself, the businesses have to pay off 90% of its earnings to its shareholders. That being said, when a business gathers its income, there's two ways to do it. Whether do they want to do expansion, if they were to do expansion through acquiring a new property, then this will also may possibly affect the dividend being paid out, because you are using some of your net income to acquire new property. So if let's say should there be a shortfall of capital, what REITs may do is that they may offer rights issue out there uh, in order to fund their new acquisition. So such instances may also uh, dilute the current share price of the underlying. So really very dependent on what is the direction of the business, if what's their free cash flow like, and also if they're holding on to a lot of cash, are they looking to expand or not? Because for REITs itself, you have to understand that it's a business that I acquire property, I rent it out, I pay off the rent to my shareholders. That's the business model. So holding on to too much cash can also be hampering, because while I'm waiting for opportunity to buy into something to garner more rental income, but I'm actually sitting on a pile of cash, and it can be a bit. I would say you're not very you're not utilizing the monies that effectively. Then thirdly would be that looking at the current environment, if you would acquire certain properties, are you buying at a premium or a discount? That's also one factor. So all this in fact will affect the overall dividend yield of such businesses, and dividend yield, they are not that's why they always say a dividend yield is not promised, but more often than not, why REITs investors themselves can expect higher or rather a steady stream of dividend payment, is because that of the structure of a REIT itself. The structure of being paying off 90% of its income to its shareholders.
Hey Rafa, we have a question from Jason, which I think is
Mm,
quite interesting. On the note of fund allocation, how
mm.
should one allocate their fund into these available REITs? With so many REITs, there are so many REITs. So which REIT sector should we place more funds in? I mean, any thoughts about to a new investor who's interested in REITs?
I don't stand for single exposure kind of REIT, because at the end of the day, I'm still promoting our fund here, right? So if let's say REITs itself, definitely if you were to buy a single ticket, for instance a single lot size of your other REITs out there in the market, you'll be spending a few hundreds or a few thousands. Whereas through the form of ETF, you'll get a basket of all these REITs through one unit. So in fact, why we actually package this up in the first place is also because that we, through this format of ETF, actually you are able to participate in all spaces with a small capital pool. And in fact, with this, you'll be exposed to the various sectors that you're looking at out there in the market. You don't have to um, chase or what's in the market and all, because usually we know that when you start chasing, probably that will be the point of time whereby you're buying things at a high, because everyone is talking about it. And that the beauty of S-Reits itself is that through its past performances, it has always been regular in its dividend payment. Secondarily is that we look at the trends of S-Reits itself. Previously, during when interest rate environment was still relatively low, we saw S-Reits paying off an average of a 4.5% dividend per annum. Whereas at this current juncture, we are looking at 5.66%. If you ask me at this current environment, is it fantastic? I will tell you, if you are looking at holding on to long term, definitely it can be a proposition. But if you're talking about risk-free rate at this current environment, you might be considering whether is it better for time deposit. I would say some people will say that, okay, if I cannot stomach risk, then it's good to go for a time deposit. But if let's say you're looking
Hi, Rafa, can you hear me? Hi, members of the audience. Just sit tight. We're getting in touch with the speaker. We'll be back very, very shortly. Hold on, please. Hi, thank you for waiting, ladies and gentlemen. Our speaker will be joining us shortly. He just had a technical boo-boo, and he'll be coming on very shortly to wrap the session up. If you have more questions about the REIT after this webinar, please send them in our survey form at the end of the webinar, and we will send them to the speaker's way so he can have it addressed for all of us.
Yeah, I think I'm back online. I think just now there were some technical issues out there.
All right, Raphael, welcome back.
Can you hear me?
Maybe yes, I can hear you loud and clear. Maybe you can show us your slides, and I can see your slides now. Maybe you
Hmm.
can tell us what do you want the audience to live with, and maybe we can wrap up the session from there.
Yeah, I think audiences out there, thank you for joining this evening session. I think it has been. I hope that it has been a fruitful one for all of you out there. Um, Most thankful to Philip Nova. I understand that you guys are starting on this journey with the allowing or trading of securities on the Philip Nova platform. So we are honored, deeply honored to be the first few asset managers to partner with Philip Nova to come on this initiative. So we also want to bring forth um, some key highlights that if you are looking to build your wealth plan, do give Philip Nova a chance to do so. You can look it up on our IHS Leaders Index ETF on their platform. Ticker code SRT for the Sing denominated one, and the SRU for US dollar denominated share class. So just to re-highlight, the management fee of this fund is actually relatively low. We are looking at 0.5% per annum. This charge to the NAV spectrum is not of additional cost to you and I or to Philip Nova, whichever. So just to key take note that during every market cycle, definitely there will be a proposition out there, or rather opportunity out there in the market. And at this current level that we're looking at around 5.6% for S-Reits yield, this is on the higher spectrum. So in the past itself, the average yield we are looking at during low interest rate environment, we're looking at around 4.5% thereabouts for S-Reits. So in fact, if your investment horizon is of longer spectrum, do give us consideration and do consider building S-REITs or incorporating S-REITs as part of your investment portfolio. All right, then with that, thank you, Sri. Thank you, Philip Nova, for having me this evening. And thank you all of you for joining us this evening.
All right, thank you so much, Rafa, and members of the audience. Thank you for joining us and asking all those wonderful questions. And if you have more questions, please send them the survey form so I can pick them up and send them Rafa's way to address. If you have any other queries, just send them the survey form. Till then, please take care and do join us for our next live webinar. Take care and good night, and thank you, Rafa.
All right, thanks, Sri. Thanks, Philip Nova, and thank all of you.